Hello and welcome to the Capital Markets Live. I'm Alvin Lam, Managing Director of International Markets at Ginnie Mae. Today I'm joined by Michael Kenken, CFA, Head of Mortgage Research at Barclays Investment Bank, leading the coverage of mortgage-backed securities encompassing both agency and non-agency RMBS. He joined Barclays in 2021, following 9 years as Senior Agency MBS Analyst at Bank of America. Prior to that, Michael spent over a decade on the buy side as a fixed income portfolio manager, trader, and quantitative researcher focused on securitized product, including 7 years at BlackRock. He earned a BA degree from Dartmouth College in 2001, majoring in economics, finance, and computer science. Welcome, Michael.
Thanks, Alvin. Thanks for inviting me. I'm happy to be here.
Well, the Federal Reserve plays a major role these days. Let's start from there. The Fed stopped buying MBS this month. What is the path of the Fed balance sheet going forward, and how does that impact MBS investors?
Yeah, so we anticipate pay downs on the order of about 20 billion a month for the foreseeable future, and actually about a quarter of it is going to come from Ginnies. And suffice to say that with a 30-year mortgage rate pushing 7% today, refinances are going to remain pretty low, and even typical housing turnover is likely to be fairly suppressed. So it's difficult in that environment to envision the Fed pay downs to even begin to approach the 35 billion monthly cap that they set for themselves. Now, of course, 20 billion per month, that's about 240 billion per year, right? Adding to the already elevated pace of organic supply in the sector. And whatever the agencies sell obviously has to be bought, and supply has to equal demand by definition. And the market typically counts on investors to reinvent their principal paydowns into the sector. But of course, when the Fed does not reinvest 240 billion, it basically means somebody else has to buy bonds. The market already expects this. They know this, right? So this has already been factored into the relatively wide spreads we see on MBS today. However, the ongoing elevated pace of organic supply, basically due to outsized home price appreciation since 2020, may not be as widely anticipated, and that could actually weigh on spreads into 2023.
Okay, the market is responding. What potential do you see the Fed to go even further and sell MBS?
Yeah, it's a good question. So the market tends to be very mercurial with this. They kind of swing in between sales being quite likely to all of a sudden nobody talking about them. And, this naturally kind of tends to coincide with bouts of surprises on inflation. When you see an upside surprise there, drives up rates and therefore fears of sales. And correspondingly, when the market gets more concerned about growth, these concerns get soothed. The Fed obviously owns discount coupons primarily that are no longer produced. So, as you might imagine, those coupons tend to trade very directionally to rates for that reason. So typical lengthening the already long durations on these bonds. But in any case, I mean, look, Powell's comments last week suggest we're probably not going to see Fed sales anytime soon. We estimate the market pricing is less than 1 in 4 chance of Fed sales now, versus essentially what was a negligible probability in mid-August before Jackson Hole and the recent CPI surprise. Personally, I feel that the probability of sales is still fairly meaningful and likely declined to about 30% from about 50% after Powell. And I think it's consensus that if they do sell, I would put it on the order of about 10 to 15 billion a month, effectively ensuring that the combined runoff from the balance sheet hits the established $35 billion cap. Of course, the outcome remains binary in nature.
Well, thank you for the comments. If the Fed doesn't sell, wouldn't the balance gravitate more toward mortgages? Wouldn't the compel the Fed to act?
Well, yeah, I mean, initially, of course it will, right? Pay downs are running considerably slower in mortgages compared to treasuries, right? And a couple of Fed speakers actually mentioned this recently. So QT has to stop at some point, right? So after a certain amount of QT, reserves in the banking system will begin to become scarce, right? And they're going to push up the Fed funds rate towards the upper bound that the Fed set. And this will basically tell the Fed that, equilibrium levels of reserves have been reached and QT has to end. This is kind of similar to what happened in September 2019. Uh, market per- Market participants have various timelines for this, ranging out as far as 2 to 3 years. But Barclays economists, for example, estimate this can happen as soon as early 2023. Now, the Fed has expressed a preference for a Treasury-only balance sheet in the long term. So the natural thing to do is to continue to run off mortgages and just kind of reinvest proceeds into Treasuries beyond that point, like they did in 2019. So even if the mortgage percentage of the balance sheet grows initially, once QT stops, it's going to decline rather rapidly as mortgages are replaced with government bonds. So look, I think nothing really compels active sales from the balance sheet perspective. And I believe that whether the Fed sells ultimately comes down to their perception of how serious the inflation problem is, how effective they are with their conventional tools. The bar for sales is likely fairly high, considering the Fed's stated normalization principle, of running off the balance sheet primarily through maturities. It's worth noting that all of the above sort of assumes that nothing bad, no major calamity befall us in the meantime, right? Should something happen to warrant another round of QE, for example, we think that MBS will once again feature prominently in that. History has shown that Treasury-only QE is not nearly as effective, for example.
Very interesting perspective. Michael, you mentioned elevated supply earlier. What's driving and giving low refis and slowing home sales?
Yeah, I'm glad you caught that. I think, look, I think it's important to recognize that a typical seller of a house, right, these days lived in their house for 5 or 6 years, right? And over this period of time, prices are up an astounding 60%. Last time the numbers were this high was, before the financial crisis, 2004 to 2007. And incidentally, those were also years of fairly unprecedented mortgage growth, right? Now, look, when the person with the 60% gain sells his $300,000 house from 2017 today for $500,000, he's going to pay off a little over $200,000 in debt, right? The buyer, assuming around 85 LTV on average, will end up taking out a little over $400,000 to fund it. That implies almost 100% increase in mortgage outstanding. So even with home sales that are 20% lower than before and negligible refis, a fairly considerable amount of new mortgage debt is being created today. Now, the market is looking back at historical supply post-crisis at similar rates, and they're seeing probably about 20 billion a month on average, or about 240 billion per year. Now, we think that because of this price dynamic, which is, by the way, unlikely to change anytime soon, right? Um, the reality is likely going to be closer to 30 billion a month than 20 billion a month. And if you add in the 20 billion per month from the Fed we discussed earlier that are running off, you end up with about 50 billion a month in mortgages that private investors need to absorb, which equates to, close to 600 billion a year. That's quite an amount, particularly with banks on the sidelines like they've been all year. In Ginnie specifically, by the way, I think that supply has also increased because FHA to conventional refis virtually disappeared above a 6% mortgage rate, but also due to the fact that Ginnie Mae just plays a larger share of the purchase market, close to about a third, compared to compared to the purchase market, right? So this is somewhat tempered by the fact that FHA buyers seem to be a little bit more, affected by the recent decline in affordability, as evidenced by the FHA purchase index, which is close to 2014, but still a lot.
Great. Since we're on the topic, who is going to absorb all the supply without the Fed?
Yeah, I think, look, the dominant buyers of mortgages in recent years have been the Fed, banks overseas, as well as mortgage REITs and money managers. Now, the Fed we just covered, and their demand is a negative 240 billion if they don't sell, and perhaps as much as 420 billion if they do, right? Banks are the largest holders of MBS and have been largely absent this year, right? During COVID, they got caught with way too many residential loans, and they've reallocated pretty significantly towards securities already. Uh, and reserve and deposit growth during QE4 also drove a lot of demand, in 2020 and 2021, creating the duration needs. And the net result, though, is that I think they basically overbought over the last couple of years. So they're now over allocated to the sector. And, at this speed, it's going to take a long time before the portfolio pays down to a more kind of normal allocation. And also, partly due to QT, deposit and reserve growth has stalled this year as well. And, mark to market in the available for sale books have triggered reallocation to hold to maturity as well at the banks. So basically, banks will probably need to raise deposit rates at some point, and that basically means that their liabilities will become a little bit more like floaters, right, as opposed to more like fixed rate assets, shortening in the duration. And this negative convexity on the liability side of the balance sheet just makes adding negatively convex mortgages unappealing as well. So while banks may buy some mortgages here, particularly if they're no longer, retaining mortgage loans at the same pace as they have been, we really think that they're unlikely to emerge as the dominant buyer that they've been in the past. Now, Ginnie Mae is a little bit of an exception to this, and the silver lining there is that the capital erosion at the banks has resulted in some risk-weighted assets constraints for the banks, and it leads for whatever mortgages banks do buy, it does lead them to favor Ginnies over conventionals this year. And you can see that they've been actually adding in Ginnies and running off conventionals. But really, away from the banks, it really leaves overseas REITs and money managers to take down all of the supply that we've been talking about. And overseas demand has been pretty strong out of China, again, probably favoring Ginnies on the margin. But for those who fund in native currencies, such as Japanese insurance companies, JGBs are likely looking more attractive here, given the hedging costs. And in general, Japanese demand is likely to prove somewhat elusive in the context of the latest BOJ intervention, essentially selling dollar assets to buy yen. But I don't anticipate them to necessarily be a significant seller, but they're just not going to be a big buyer, right? So historically, wide spreads do create some potential for REIT demand, who are essentially leveraged basis investors, mostly in conventionals. But ultimately, look, it's going to be the money managers. It's going to have to be the relative value focused money managers who need to bear the brunt of the supply and be the marginal buyer. They're going to be very spread conscious. They're not yield buyers. And I think it's going to emphasize valuations going forward relative to other alternatives, spreads like measures like OAS and stuff as we go into 2023.
Thank you for the long and detailed answers. Really appreciate that. Let's talk about Ginnie Mae. What do you think of Ginnie Mae to MBS spreads to Treasury here?
Well, some of these themes we talked about on supply and the demand side of things suggest spreads probably need to remain to the wide end of what you would consider fair historically, right? Incidentally, today that's kind of where they are, and mortgage basis looks pretty good here, priced at the level that's compelling versus corporates or rates, for example. So Genies specifically are not far off from levels seen in the past, and they've benefited already disproportionately versus conventionals from the deliverable shift this year in production to faster turnover, and partly due to their weaker borrower credit profile and the diminishing value of the MIPCAT risk as bond premiums decline. Speaking of that, the market is basically pricing a cut at this point, again, removing some of the headwinds for the sector. We see generally value in the higher part of the coupon stack where spreads are more appealing. And we think that those are relatively insulated from any Fed sales as well, but also face the brunt of the supply pressure that we talked about. We do anticipate originators to consolidate quite a bit this year, which should help with the call profile of these bonds. And paying for seasoning, we think, makes sense for us too, as new production TBAs are unlikely to realize the fast speeds currently seen on the more seasoned bonds, right? Likely lacking the type of home price growth that those guys have experienced. One example of that would be the custom discount RG pools, for example, on Ginnies, which look quite cheap, for example, offering seasoning at a discount.
That's a lot of insights. Thank you so much, Michael. Thank you for your thoughtful insights. Well, it looks like that is all the time we have for today. With that, Michael, thank you again for your time discussing the Federal Reserve and the end of the purchase of MBS.
Yeah, thanks for having me.
If you enjoyed the podcast today, be sure to subscribe our future episodes of Capital Markets Live on YouTube. If you have any comments or questions about today's episode or other topics, please send us an email at ocmglobalinvestorinquiries@hut.gov. Again, the email is ocmglobalinvestorinquiries@hud.gov. Thank you for listening.